We've got a really pacey, high-level conversation for you next on macroeconomic themes. We're talking about central bank policy, inflation, the outlook for the markets. And I say pacey, Stephen, because Stephen Sobey, is head of media relations, is moderating. He's got 4 portfolio managers with him. You've only got 15 minutes, Stephen, so take it away.
Thank you so much, Lucy. Hello, I'm Stephen Sobey. I'm the head of media relations at Janus Henderson, and I'm not used to being on this side of the camera, so I hope our panel will go easy on me today. We're going to discuss, as Lucy said, big macroeconomic themes. We're going to run the whole gamut, and we've got an all-star lineup for you today. We've got Paul O'Connor, our head of multi-asset, and then from our global bonds team, we've got Jason England, who's calling in from Denver, Helen Anthony, and our head of global aggregate, Andrew Mulliner. Thank you so much for joining us today, panel. Great to see you. As Lucy said, we're covering a lot of ground, but Paul, to kick off, we've discussed between us the volatility around 2022, you've written, and 2021 rather, and you've written at length about the macro conditions for last year. Could you set the scene, talk about some of the bigger themes and what the current macroeconomic environment means for investors?
We've certainly seen a very lively start to the year in global markets, double-digit drawdowns in the S&P and the Nasdaq, some extraordinary intraday volatility in stocks, and this volatility is spread to government bonds and corporate debt as well. I think the big picture here is we're moving through the third stage of the pandemic from a financial market perspective. The first stage was the growth shock of 2020, then with the inflation surge last year, and now we're dealing with the policy shock. And part of the policy shock is what's happening on the fiscal side, but the big story is really what's happening on the monetary side. And what investors are really grappling with is trying to calibrate this hawkish shift we've seen from the central banks over the last few months. And it has been really dramatic. If you look at the Fed, back in September, the Fed was telling us that inflation would be transitory. Markets were expecting no hikes at all in 2022 from the US. And then you fast forward to today, and markets are pricing in a handful of hikes this year and more next year. So it's been a very abrupt rethink. And investors are really struggling to get their head around this interest rate cycle because it's a very unusual one. We start from a strange position of monetary policy being extremely accommodative, low real rates in QE, and we start very late. You know, we've just seen today, US CPI is already hitting 7.5%. We're close to full employment, and the cycle only begins. So that's the big question. You know, monetary policy has been the big source of macro uncertainty. It's been the big driver of market volatility. And for all of the fund managers, I think getting this monetary policy call right is really going to be the most important call for the next few months and maybe for the whole of 2022.
Thank you for that, Paul. So I suppose the critical point here is inflation, and the entire world's freaking out about inflation. Are they right to be? And can any of you see it peaking soon? Andy, do you want to maybe start?
Yeah, so I mean, inflation is definitely the watchword for the current for all investors right now. You know, as Paul said, we've just had a big number out of the US today, and it looks pretty broadly spread out. But I think, you know, probably when I think about what is important here, what do we really want to focus on? The things we're freaking out about, i.e. the inflation number, misses perhaps the bigger point, which is the impact it's having on real income, essentially, right now. The sort of inflation we're getting is driven a lot by sort of the supply disruptions that have resulted from the pandemic. We've seen a big increase in, say, things like gasoline prices as well feeding through, and a big increase in things like food prices now as well. Again, all related to these sort of pandemic-related supply disruptions. There is some evidence that there's some input now from wages as well, and certainly in places like the US and to a degree the UK, but it's more modest. And I think this is the thing. Right now, even though people are talking, oh, inflation is very high, we're very behind the curve, as Paul suggested, actually, when I look at what's actually going on right now, we see an income shock. Essentially, people's incomes are falling in real terms. And so when we think about, are we freaking out about, we're probably freaking out about the wrong thing. Looking 6 months ahead or so, we could be looking at much weaker growth as a result of the impact of inflation. And whereas we see further 12 months further out, probably inflation's quite a bit lower because a lot of these, the things that are impacting now are not the sort of things that are going to persist longer term.
And Helen, did you want to pick up on if we're looking at a peak coming, or sorry, to use the most used words of 2021, you're on.
Sorry, hi. Yeah, I just follow up on Andy's point. Right now, we're actually going through kind of the peak stage of inflation. Probably, I think about April, we hit the peaks in the US, and then it's actually set to fall. So by the end of the year, we're actually in quite a different inflationary dynamic for the central banks. One where actually, yes, right now they're more hawkish, they're saying, and kind of pushing rates higher, but actually it will be an interesting end to this year, I think. So we see inflation kind of towards central bank targets actually by the end of this year.
So just to think about that, is there looming sort of a return to the 1970s? You know, we're used to stable prices, but are we back in that kind of an inflationary cycle? Andy?
I mean, yeah, so the return to the 70s, I think that's probably, if you ask most central bankers, they're probably of a certain vintage whereby the 70s is a period of time they can actually remember, something that, you know, perhaps happily for me, I can't. So, but I think, you know, there's always a danger you fight the last war, and I think this is probably a classic case of that. There's, you know, certain similarities, i.e. we've got supply shocks, we had an oil shock in the 70s, but there's some really, really big differences, and I think the big differences really need to be, you know, brought out here, and that is, you know, demographics. In the 70s, we had the baby boomers sort of like coming of age and basically acquiring stuff and having families. Essentially, we don't have that now. Demographics are very different in the developed world. You know, technology has been a persistent disinflationary force for the past 20 years. Technology has become more apparent through the pandemic. And then, of course, you've got things like globalization, etc., all of which is, you know, part of this story of, you know, lower prices through time, but has been, you know, let's say, disrupted by the pandemic. And I think it disrupted in ways that are quite hard to predict and quite hard to understand. But I suppose going back to that point about persistence, these are sorts of things that we would expect to roll off essentially through time. So I think, you know, comparisons with the 70s are, you know, ill-advised. You know, perhaps like history does rhyme, but I think that's probably going a bit too far back in terms of history, from my perspective at least.
I think Paul and I will keep quiet about how much we remember the 70s. But is anyone missing a trick here? Are there any benefits or opportunities for investors as a result of high inflation?
So this is one of those classic cases of a little bit of something is a good thing and too much is a bad. So, you know, it's worth remembering that central bankers have been targeting a bit of inflation for quite a while, like, you know, that 2% level. And that's because, you know, that's perceived to be the right amount to keep people spending a fairly consistent amount and allow, you know, companies to invest and people to make plans for the future on a stable price perspective. Too much inflation disrupts all of that. So from an investor's perspective and an economic perspective, you know, too much inflation, that's a bad thing. So we definitely want to avoid that. You know, if you were looking for like societal benefits, if you will, I guess you could say the fact that we're beginning to see some pricing power return to labour, certainly in some parts of the market. You know, the last 25 years has seen a persistent sort of like decline in the pricing power of labour, i.e. the ability for people to demand higher wages. So I guess you could make that as a good thing. But again, like, you know, take that to an extreme and we're in a very different space. So I probably tend to say that, no, there's really not many good things to come from high inflation.
Jason, just to bring you in here, what are the central banks? The Bank of England has already gone forward last week, and I mean, the Fed. Are you pricing in higher rates until the end of this year?
Yes, I mean, I think we've reached peak uncertainty with central bank policy right now around the globe. As Paul pointed out, you know, really judging or trying to forecast monetary policy is going to be key this year. It's really the reaction function right now is quite surprising of global central banks and how quickly they've pivoted to hawkish over the last several months. As you mentioned, the B of E, the Bank of England, you know, they hiked a small amount last year. They just hiked another 25 basis points this month. They have another 5 hikes, or the market is pricing another 5 hikes this year. You also have the surprise announcement recently that they want to sell the 20 billion worth of their corporate bond holdings, and that kind of spooked markets a little bit. So not only are we seeing hiking cycles by the Bank of England, but also quantitative tightening. Now in the US, you also see the Fed, you know, they went from, you know, a 50-50 shot at maybe one hike back, you know, on their September dot plots for 2022, and now all of a sudden you get to December, they're pricing in 3. Now they get to, this early in the year where the market's pricing in 5 now. So you're seeing a rapid pace of those rate hikes getting pushed forward. Also, you see the wind down of quantitative easing several months earlier than planned, ending in March. And then now, on the table now is balance sheet runoff and how quickly that's going to happen. And then you even have, the ECB now that have been, never, reached liftoff after the great financial crisis and have been sitting on hold for over a decade now. Even they are getting a little bit hawkish and talking maybe rate hikes this year. So you've really seen a shift across the global landscape of central banks really starting to get more hawkish, not only in the rate hiking cycle, but balance sheet runoff. And, in the case of the Bank of England, actual selling assets. And there is talks that, at some point, maybe the US, some of the Fed members have come out and said they would be okay supporting sales of mortgage-backed securities to try to get their balance sheet back to treasury only. So it has really been a drastic change over the last several months of how hawkish these central banks have become.
So given the macro environment discussed, so Paul, why don't you kick off? Where are you looking in the multi-asset space? What assets are you looking at right now?
Well, we are finding some opportunities in this volatility, Stephen. I think in fixed income, I'd say it's a little early to add to duration, but we're finding some opportunities emerging in credit, particularly European high yield we like after the recent wobble. In equities, we're sticking with a pro-value overgrowth tilt, which leaves us favoring the UK and Japan and the Eurozone over the US. But I think the one exception to that is we think growth stocks are looking very oversold in Asia in general and Japan in particular. And then EM is an area where we've been underweight both debt and equity. I think EM equity, it's time to get back towards a more neutral position. I think the concerns about Chinese regulation and Chinese growth are well understood and well priced in. Emerging market debt, I don't think we're ready to add yet because it is struggling against this broader backdrop of higher yields that we've all talked about. But at least in EMD, we can point to the fact that the interest rate cycle in the emerging economies is getting quite well advanced. So I think this is going to be a year of market volatility. And of course, that at times will be a source of discomfort. It's not particularly easy all the time, but it also is a great chance for active managers like us to add some value.
Thank you, Paul. And Helen, just to draw us to a close, after last week's market frenzy, where are you looking in fixed income?
Yeah, exactly. Well, not just even the last week, but actually over the last month to 3 months, fixed income's actually come under quite a lot of pressure from a total return perspective. But actually now we're seeing quite a lot of value within fixed income markets. And similar to Paul, we really like European high yield. Another asset class that actually started to look slightly more favourable is investment grade credit also.
Brilliant, brilliant. Thank you very much, panel. That was absolutely fantastic. A whistle stop through macroeconomics, which I haven't studied since I was 17, so that was a good refresher. There we are. We'll hand back to Lucy. Thank you.
Totally agree, Stephen. Fantastic pacey session there. We covered a huge amount in that short amount of time. So thanks to all of you. Lots to talk about inflation, of course, but really good to hear all of your thoughts. I vaguely remember the 70s. I was small, but yeah, took me back. Thanks so much, everybody.